All right. Welcome, everyone. We'll give people just a minute to come in. Hope you're having a wonderful Wednesday so far. For those of you who don't know me, I'm Megan Stokely. I'm the marketing director here at FounderMade. And at FounderMade, our whole mission is to provide founders and entrepreneurs a platform and community and all the tools they need to massively scale their businesses. And these power hours really serve as deep dive strategy sessions where you can learn from the experts and get insights into things you can apply directly to your business as you build. So be sure to introduce yourself in the chat, tell us about what you're building, and of course, use the chat and Q&A function to ask questions to our expert speakers today. We'll be sure to get those answered live for you. And today's Power Hour is presented by Pilot. We'll be taking a look at the various paths to capital for consumer brands. And as I'm sure you know, there are many different paths, and the right path varies from business to business. So today we'll be getting different perspectives from the founders of some super amazing brands who've all had very different journeys. And with that, I'd like to pass it over to Eugene Lim, who is the head of CFO services at Pilot. Eugene, welcome. I'll let you take it away and tell our audience a little bit about yourself, about Pilot, and of course, about the awesome conversation you'll be leading today.
Sounds good. Thank you, Megan. And thanks everyone for joining us today. We have an incredible panel, as Megan has shared. They've built incredible brands with different viewpoints on how you can think about fundraising as you build your own company. As a quick intro on myself, my name is Eugene. I currently lead CFO services here at Pilot. Prior to joining Pilot, I led the strategic finance team at Wish, focused on the logistics build out as well as their inventory white labeling system. And before that, I spent some time in venture capital with Andreessen Horowitz evaluating early stage consumer businesses. So I will now turn it over to the rest of the team that we have here today for them to share a bit about themselves and what they're building with their respective companies. I'll go in the order of what's presented on the slide here. Let's start with Lisa Marie.
Hi, everybody. My name is Lisa Marie Poso. I'm the founder and CEO of Gifting. We provide companies, creators, and consumers with diverse and inclusive gifting solutions, and we specialize in curated gift boxes.
Hi, everyone. I'm Caroline Howard. I'm a co-founder at Walker Brothers, a craft kombucha brand based in Nashville, Tennessee. We brew both non-alcoholic and hard kombucha.
Hi, everyone. I'm Katie. I started Nave as the first pet wellness company loved by humans and pet parents. We're based in Austin, Texas, and have about 10 people and going strong.
Thank you for the intros. As you can see, we have a wide variety of different verticals that our founder friends here are focusing on as they go through building their company. We have an existing session here to talk about the various pathways for growth for consumer companies. And as Megan has appropriately said in the beginning, there's no one right path. There are different typical fundraising paths. So let's talk about where each of our guests are in their fundraising journey, and then we'll go deeper into the different paths that they've taken. Katie, why don't we start off with your company? How have you decided on what funding stage or what funding path to take your company in, and how has that gone so far?
Yeah, so I founded Nave officially 3 years ago and had been thinking about it for a few years prior to that. From the jump, we decided to go with venture capital financing, and we've done that since. So I probably have the most boring answer of the team here. But for us, we thought a lot about the different ways to finance the company. And I had been thinking about Mave in this market really informally prior. And so we were running these light beta tests. And by the time I was ready to pull the trigger and say, this is what I want to work on full time, we had a good amount of data on our customers. And we were thinking about the scale and timeline expectations that we wanted as founders and a team, and what the market could serve versus what investors expected, and found that venture capitalists really well aligned with what we wanted to build. and decided to jump in.
Were there any other fundraising paths that you were thinking about? What are the trade-offs that you thought about before you decided to go into venture capital?
Yeah, we definitely thought about a handful. We thought about friends and family. We thought about angels. When I was informally thinking about the market, I quit my job. I was a dog walker for a year. I debated dropping out of business school once I knew that this was the thing I wanted to do. And I had self-funded a small amount, but didn't have the personal capital to fund the first 6 to 12 months. I was really excited to do that if I could have financially, because you get to own way more of your destiny, and everything is such an unknown at that point that inviting outside investors to weigh in on the path and daily decisions is a big risk. You really do tie yourself to those people for the rest of the company, and they take an ownership stake and they get to weigh in on things as a result. Personally, couldn't do that. Thought about friends and family and angels, and I think for us, we had existing relationships with investors who came from institutional funds. I was really worried about friends and family personally because of the commitment to those people and the pressure that comes with it that just doesn't weigh on a founder, wasn't going to weigh on me as much personally with a venture investor.
It's interesting that you say that. I think even within this panel here, I'd love to hear about your experience with raising friends and family fund, because I think a misconception that folks have is it can be less stressful than raising VC money. So would love to hear from Lisa Marie. I know you have some experience or thoughts there, and then also from Caroline too.
Yeah, so what we actually ended up doing in the very beginning was, instead of a friends and family raise, we did a friends and family pre-sale. And we said, okay, let's make a small box. Let's put it at a price that's attainable for, friends and family. We were in the middle of a pandemic, mind you. So we actually launched today's our 1-year anniversary of our launch. So yes, thank you very much. It's very exciting.
Congrats.
Thank you. Thank you. Yeah. So a year ago today, we launched our friends and family sale, which allowed us to kind of sustain for like a month until we figured out what we could do. We originally started the company from my unemployment checks, actually. So we were in a very interesting, frugal place for a while until that sale, which kind of allowed us to give us the little jumpstart that we needed without the pressure of accepting actual investments from friends and family. Because like Katie said, that is very scary and it's a lot of pressure to ask people for that money.
Yeah, I can jump in on that point too. So for context, Walker Brothers is currently funded with a mix of founder capital, family and friends, and angel investors. And so around this time last year, we were actually raising an angel and then family and friends round. And I would say that what you guys have said is absolutely true. While that those types of capital can be more patient, oftentimes you do have that personal relationship with those folks. And for me personally, it actually kind of feels more stressful in a lot of ways, because these are people that you know, and they've trusted you to be a steward of their capital. And so you have to know that every day you're going into the business, making decisions about what to do. And, you need to deliver outsized returns for these people who have trusted you. So yeah, it's great to have people that believe in your business and know you personally, but it also does weigh on you, which can be good and bad.
Yeah, it's a lot of trust that your friends and family are placing on you with their own personal capital as well. So I can definitely see why that adds an additional weight, but also an additional motivation to push your company to generate that outsized return for them. I want to go back a bit to that VC capital. Katie, did you decide to seek out consumer-specific investors as you were raising VC fundings, or were you trying to stay more general?
So we've raised 2 or 3 rounds of venture financing, and for our first round, we were looking for consumer investors who would understand what a pre-seed consumer business needed to build to get from 0 to 1. We ended up bringing in a mix. Our lead investor for the pre-seed was a direct-to-consumer wellness company experienced investor. And that was great because she could provide specific advice, she could provide introductions, she could tell us, here's what my other companies in the portfolio do. And then we had a mix of other people too, from generalist firms and from tech specific firms, which I think worked really well.
Got it. And if you don't mind sharing a bit more, what were some of the key metrics that a consumer specific investor focused on versus the other investor profile that doesn't have a consumer mindset focused on?
Yeah, at the pre-seed level, metrics were really a secondary part of the conversation. We've since raised a seed and are thinking about an A and the timing of the A. So metrics are my first and last thing I think about when I wake up and go to sleep. But at the pre-seed level, everyone was looking for story and why we cared. And they were looking for founder market fit as well. They were excited when we had metrics because I had run this very light beta. I had this year of experience as a dog walker. I'm a numbers person, so I was like, look at my numbers, please. But at the pre-seed level, any indication about the total market or some core insight we had about our consumers that we could tack into that our competitors couldn't, that was most enticing. And then I think consumer investors really grilled us about our go-to-market plan and our marketing strategy more so than the tech investors or the generalist investors.
Mm-hmm. And for the go-to-market plan, I think having been on the investor seat myself, we've seen a bunch of different go-to-market plans. And ultimately, as you said, it depends on the founder market fit and their motivation to push the go-to-market plan into completion. Have you found it to be the case that investors are actually helpful about helping you get to that next level once they put in the funding? And the reason I asked this is we had a question previously around what you can expect from a pre-seed investor coming in while you're still determining that product market fit.
Yeah, that's a really good question. You can expect different things from different investors, and that should totally be a question that you ask your pre-seed investors before letting them invest in your company. For us, we wanted a mix of people who'd be highly involved and people who'd be more hands-off but available to take our calls. And we found that they were all helpful in getting to the next stage. I think more and more my job is just hearing advice, hearing directly conflicting advice from everyone at the table and then making a decision. So there was never a shortage of advice. And at the end of the day, that was helpful. Some days that was conflicting and a puzzle to solve, but they definitely helped us through advice, relationships, just information by having an information asymmetry, which was great.
Thank you for sharing that. I love how you mentioned that it's something that you should vet as you are identifying the right pre-seed investor. It's often a two-way conversation. You want to make sure that you have a good fit with the investor coming in, and the investor also has conviction on helping you to grow your company. If you could sum up in one word, how did you feel the first time someone brought up, all right, let's go fundraising? How did you feel about that going into that process?
One word. One word, competitive. Second word, daunting. And I think I still feel that way going into fundraising, even looking forward.
Can you elaborate more about that competitive aspect about fundraising?
Yeah. When we thought about fundraising, once we knew we wanted to go the venture capital route, we heard all of this advice about how daunting it is, how it's going to take 6 months. You're going to hear no 99 times, and you just need to hear one yes, and then the ball gets rolling. And so many of our advisors at the time were just giving us pep talks. And so for me, I had this, I put on a hat when I'm fundraising to say, like, I am selling the business. I'm pitching it as a sale, and I'm going to get the best possible investor at the best possible valuation for the stage that we're at so that we can grow at the pace that we want. And it is a competition against the other people in your category who are also fundraising at the same time. It's a competition against the other people on the investor's calendar to get the share of their brain, to make them keep thinking about you at the end of the day and think, I got to invest in that company. I still feel very competitive when in that position.
Yeah, it's definitely a competitive process. And I think, given the number of rounds that you've raised so far, it's clear that Maeve has done very well in selling the story and showing that outsized potential returns and momentum in the company. So congratulations on that.
Yeah.
Before we move into the next alternative path of funding, we actually have a really good question from our audience. So Kat asks, I'm new to venture capital and seeking investors. We have bootstrapped to 4.5 million per year, but growing too fast to keep up with cash flow. What would you suggest? And Katie, I'd love to direct this question to you because the way that you shared how you talked about going down the VC path is you knew that there was this growth rate in this market that required VC funding. So could you chat about what would you suggest in seeking venture capital investors when you're at that stage in the company?
Yeah, I mean, congratulations. To bootstrap to that ARR is amazing. You clearly are onto something and have the grit, and that's huge. I'm just impressed, first of all. I think there are also a bunch of ways to continue fueling working capital needs or other kinds of needs. If you have 4.5 million per year in revenue, you've got options. Your back is not against a wall. When it comes to finding the right investors, I would look for people in your network who are connected to other investors, and I would do that from a bottom-up perspective. And then I would look across the world of investors and make a list of who your top 5 wish list would be, or top 10 wish list, and then just start to close in on it. It always starts with a pitch deck and just circulating it and constantly tweaking it to optimize your sales process and hear what people are asking and what metrics they may be looking for that you don't have. But I mean, you've clearly built a business from scratch. This should be nothing for you, which is exciting.
Yeah, congratulations, Kat, for building that business to 4.5 million per year. I want to move to a different school of thought here. I think VC path is one that is right for some companies, but it's not always right for all companies. Sometimes there's that group think that happens where, okay, everyone needs to raise VC funding. Lisa Marie, could you share a bit more about when you were raising funding for gifting? Was VC path how did you determine if VC path was the right call to make or the right path to pursue?
So that's the direction that we were initially pushed in, because I think people have this conception of fundraising that you have to raise VC money to be successful and you have to have a crazy valuation to be successful. But at the end of the day, you know your business better than anybody else, and you know what's right and what's not. So we had to kind of take a step back and really reevaluate and re-strategize what made sense for us. And for us, it was not VC funding for multiple reasons. So it was one that we were way too small for venture capital funding in the terms of we were just getting started. We also weren't tech enough. We were told that we weren't, software enough. And we kind of had these setbacks, I guess, in terms of not being enough of what they were looking for. But in fact, when we started talking to more strategic angel investors, we realized that we were plenty in ourselves and we were enough for them. And they really kind of, just had a really strong feeling about our mission, and, supporting diverse and inclusive brands was really important to them. And something that is kind of different between VC and angel money is the fact that they were really interested in our story and our mission and about us helping people, where when we spoke to venture capitalists, they were more interested in how do we get to $1 billion? How do we get to, $100 million a year or a month? So it was completely different conversations that kind of shaped the way that we looked at our company. And that's how we decided on angels.
Yeah, thank you for sharing that. And for angel investors, Caroline, you have some experience in the in raising angel money as well. Can you elaborate more about what are some things that they are looking for? Is it similar to the story that Lisa Marie shared, where they cared a lot more about the mission rather than that headline number of what the ultimate revenue number would be?
Yeah, so I think every investor, every angel investor has a different point of view in terms of what they're looking for in their portfolio, and sometimes it varies depending on what's already in their portfolio, right? So I won't pretend to know kind of what everyone's looking for, but I will say that the softer side of things does tend to play more of a role. You know, do they align with what your company's mission is? Do they know you personally? In our case, a lot of our angel investors are people that were former colleagues of mine or kind of in my extended network, and they've seen my work product before. So they kind of trust that, you know, I'm going to do a good job. Do they know you personally? I would also say, like, are they interested in the region that you're operating in? So for us, we're based in Nashville, and we're, you know, basically a health food brand, and the Southeast isn't traditionally associated with that. And so we have some folks that are, you know, really passionate about that, and that, you know, that's what drew them to our business. So I would say it's not just about the return, but I won't lie and say that our investors aren't motivated by the idea of a financial return. They might not be looking for a 10x return, but they still expect for the business to get there. So yeah, I think it just depends, and kind of understanding maybe what the person that you're pitching to, what they're looking for. You can tailor that, obviously be authentic and be truthful about your brand, but, you know, kind of doing some due diligence of your own going into the conversation can be helpful.
Yeah, I know that you talked about due diligence on raising money from angel investors. How will you go about finding angel investors that are a good fit? Are there some due diligence that you do on your own before accepting that check from an angel?
So I would say our angel round was more organic than that. So for context, Walker Brothers sold its first can of kombucha in October of 2019, and my husband and I actually started as the brand's first family and friends investors before I joined full time to help build the business. And so that capital injection got the business through its first year of operations before we went and raised kind of like outside capital, if you will. So by the time that we were raising outside capital, you know, kind of people in our network knew that this was something that we were involved in and had seen the results of the business in that year. And so they had been kind of knocking at the door saying, hey, we want to get in on Walker Brothers. So we had like kind of a pre-existing stable of folks that were interested. So we were able to just tap into that. And it made for a fairly quick fundraising process.
It's great to hear that you had that organic fundraise with angels. I want to share a bit about angel investors as well, because I do speak to a lot of early stage startups, and that's usually a path that folks will start with before raising institutional capital. And there sometimes are concerns that you have too many angels on the cap table, or you're speaking to too many angels. But actually, what we've found from the successful companies that we've seen is it's very rare that you see malicious angels. It's usually easy to tell if it's someone that you know very well, or you just pick up a call to talk to a company that they've invested in before to get their experience. So even if you have a neutral angel and they are giving you money to help grow your company, I would say collect as many checks as you can in the angel investor round, and then use that to build a company with that sustained metrics so that you can raise institutional capital if that's a path that you want to pursue in the future. So in short, if you're reasonably confident, you can filter out angel investors. The only way to increase your probability is to let more people to the cap table. If most are neutral, it's not a bad thing. But if you're extremely restrictive, the probability dictates that you're virtually guaranteed to miss out on transformational angels. I've heard of cases where the angel investors are also the one that help broker the introduction to an institutional VC that the founder may not necessarily have that direct access to in the beginning. All right. So pre-angels, there's also the thought of like bootstrapping and loans. Lisa Marie, you talked about the pre-sale boxes initially during the beginning of the conversation, but I'd love to hear from you. From that pre-sale boxes, it helped to raise initial capital. How long did that shape of capital kind of got you ready to start raising angel or equity capital later on?
Yeah, great question. So it really did not last very long. Things were a lot more expensive and moved a lot more slowly than I realized. So it really was only about a month. And then keep in mind at this point, we were still using a little bit of my co-founder's initial investment, more of my unemployment checks to get it up and running. And then we kind of actually took a first check from an angel by accident. Her name's Lucy Gua. I actually met her at Burning Man and I randomly saw she was in town. I had coffee with her and she was like, "Oh, what are you working on?" Showed her a very bad deck. And this was right around the same time that the friends and family sale was launching. And she was like, "Oh, this is great. Like, I'll give you $100,000, which is completely unheard of. I wasn't even pitching her. I was just like, "Oh, what? Oh, you're an investor? Okay." And so that thankfully shaped our future. Without that money, we would not be in the position that we're in now. So yeah, that's very rare, very random. But after that check, and from some of her guidance and strategy and kind of just, strategic help or strategic advice from all sides, from, friends and stuff, we've been able to get into a position now where we're going to be raising money starting in September, actually, from more angels. So we started in June. We had a really bad experience. We totally reeled it back in, pulled back the reins, and we're restarting over now.
If you could share some advice with the audience, since you are restarting that process, what should folks do to prepare ahead of going into fundraising to make sure that they have all of their ducks in a row?
Yeah, I think Katie said it great in the beginning. And of course, I lost my train of thought of what she said about basically just you're getting so much advice from so many different people. And at the end of the day, you have to be the one who says, "Okay, I know my company better than anyone. I'm taking all of this advice, making the best decision possible for us as a unit to move us forward." So it was really difficult for us. We got very, very conflicting advice from lawyers, financial advisors, current investors, friends, family, everything. At the end of the day, I would say, listen to your heart, trust your intuition, and know that whatever you are, thinking is the right thing for you, you have to act on that. So what happened to us is essentially, we were very, I don't want to say pushed, but we were very encouraged to dive right in. We actually reached out to our investor and we're like, "Oh, we're thinking of coming to Miami. We want to raise money, blah, blah, blah." And she's like, "You have to come this week." She's like, there's a Bitcoin conference. Everyone's in town. Come this week. And we're like, "Oh shit. Okay. Yeah, we're going to come this week." We, in 4 days, put together a deck. We put together everything. Actually, our pilot CFO, Alex, is amazing. He came into our office on a Sunday of Labor Day weekend, finished all of our annual budgets in person with us, and was like, "Okay, you guys got this." So it was not an ideal experience at all. We really were just kind of thrown into it. And on top of that, we were in the middle of switching legal counsel. So for the people who were committing, we couldn't even get them paperwork. And it was very much a wishy-washy situation where we were looking really bad to these potential investors because we didn't have clear answers. And we were really just honestly making shit up as we were going because we had no idea what to expect. So I do regret that, but I also am glad that we went through it. And now that we can, start fresh, we still have a lot of people still interested. We have 50% of the round committed already and it hasn't even started. So we're feeling really, excited to go back into it.
I'm excited to see you continue to grow as well. I think, as you said, it's a mix of timing and also being ready for a fundraise. If the timing is not right and you don't feel ready, it probably is not the right time, regardless of what other people are saying or what the market is saying. If you are ready and the timing is right, a few tactical, almost checklists I want to share that you want to have ready are your incorporation documents, your cap table. Your legal advisors can help with that. From a financial side, you would want to have ready your historical financials and also a high level of your forecast. It doesn't have to be a super detailed model if your business is still in the early stages, but investors just want to have an idea of how you think about growth and how you think about how much is needed to achieve that growth. So as long as you can talk about that through the forecast, that's already putting you ahead of the game from a lot of founders that are going to fundraise for the first time. And then the next aspect to think about, which everyone here on the panel have talked about, is preparing your pitch deck. And your pitch deck should talk about what you do, what's the total addressable market, why you are the best person to lead this company and this industry, and how you'll be the market leader here. So that's some technical advice that I can share with folks. We have a lot of good questions here, actually, and this I'm going to open to all of the panel to jump in. Have you evaluated crowdfunding platforms? So we've talked about angel investors, friends and family, pre-sale VC money. What about crowdfunding platforms? Have any of you had experience or evaluated that as an option?
Yeah, I'll dive in. So we actually were told in the beginning of us even thinking about fundraising that crowdsourcing would be a really awesome option for us. I, for some reason, and this is just me being weird maybe, but I was so against it. I don't know if it was the time commitment or the fact that, we're having to ask people for money that are just kind of regular people. I just was not comfortable with it and I didn't want to explore it further. But looking back, I do think that it could have been extremely valuable for us. And I do wish that I would have kind of opened my mindset about it. So I think that it is a great option and I definitely recommend looking into it.
We considered it very briefly. We've always been a part of these founder circles, which is a lifesaver for me as an aside. And many of the people in founder circles before we were launching had gone through crowdfunding platforms. And I think for us, the biggest piece of advice that we heard was you'll see these success stories from those platforms and it looks like it was just added to the platform and suddenly it was funded and overfunded. And in reality, it takes so much work, pre-work in advance of putting it on the platform, pushing to get the word out. And so it's not an overnight success. It's not as easy as it looks. It does take a lot of work to end up being successful on those platforms. And so before you choose to go that route, make sure it's a fit for your product, service, and pitch, and then try to get the buzz before it goes live.
Definitely.
Yeah, I think we've seen some success with crowdfunding, but to your point, Katie, it depends on the product as well. The ones that have had the most success are the ones that can create that hype to drive traffic into that crowdfunding program. And interestingly, that also comes with ad spending. So the total headline number that you see on the crowdfunding number is not always the amount that you are raising for your company because there's that additional expense that goes into it. Mike on the chat has also echoed what we've said here. Crowdfunding is a full-time job and can be a distraction. Many of the hugely successful campaigns have agencies behind them that take big cuts. So that's something to keep in mind as you consider crowdfunding as an option.
Yeah, and I don't know if this is still true, but I know that historically there's been some thought that if you're crowdfunding, it's because you haven't been able to obtain capital elsewhere. So it can be a bit of a negative signal. So if you're going into it, you should be really intentional that you're doing crowdfunding for a purpose because you have a business that can benefit from having a lot of advocates, and you're like intentionally going down that path. It should not be an afterthought.
And if I may, I do want to chime into something that Mike also mentioned about crowdfunding being a full-time job. One thing that I did not know at all is that fundraising in general is a full-time job. It is so tedious and it takes so much, not only time, but your energy. Especially for me, I found it really emotionally draining because, you know, like Katie said, you're selling not only the business, but yourself, and you're selling all day, every day if you have back-to-back meetings. So it got to a point where I was only scheduling meetings in certain time blocks so that I could, you know, get my energy back up before going into it again. So for me, it was a big emotional drain for sure.
Yeah, being a founder is a super stressful job and also one that's very rewarding. So really have a lot of respect for everyone here in the chat as well as on the panel. On that same vein, someone on the chat asked, do you have any advice for solo entrepreneurs? And I'm gonna dig deeper to this question. I think the crux of this question is there's so many things that we talked about. Thinking about growing your business, thinking about making sure your business doesn't run out of money, putting together your financial forecast, getting your pitch deck ready. How do the three of you kind of split your time or manage your time to make sure that you have money to run the business and also to grow the business? And maybe we can start with Caroline.
Sure. So I'm fortunate to have two co-founders in the Walker brothers themselves, Sam and Luke Walker. So they respectively run productions, so coming up with all of our wonderful flavors and running the brew house. And then we have Sam on the sales side, who's out, you know, selling the kombucha every day, slinging booch, as we like to say. And so really where I slot in is kind of running these processes, right? Like running, you know, fundraising, running back-end operations and, you know, strategy for the business. So I think for us, kind of the split in our respective backgrounds and, you know, what we love doing, it's worked out quite well for us. But can fully like understand what Lisa Marie is saying around needing to carve out time to re-energize. Like even when we were going through the angel kind of raise last year, definitely needed to take time to recharge and do things that weren't quite so draining.
I think what you said around finding the things that you're strong at and the things that you're good at, or the things you're strong at and things you enjoy, that is so critical for us on our team, not just me as the founder, but the entire team. We're at 7 full-time people and everyone has a job title, but is working above and below it. And you're constantly stretched. And so I'm pulled into any topic under the sun, and knowing that I'm self-aware about the things I really enjoy and the things I really don't enjoy, so I can be specific about when to delegate, has really helped us remain happy as a team when you're stretched.
Yeah, and I will add that 1 + 1 = 3, sometimes even more. If you can even just have one co-founder or one ride or die person on your team that you really trust, that you can pass things off to, or trust that you don't have to micromanage, it is critical to your success and critical to the success of the company. I would not have done this without my co-founder. I think I would have tried, but it wouldn't have happened the way it has. Granted, she is not full-time, but she is full enough time that we make it work. And I just can't even picture doing it alone. I did have a company before this that I was alone in, and this is a completely different world for me now. You can accomplish so many more things. You can get so much more done. You can get triple the clients. It's just, there's so many more things that you can take on when you have a partner. And I highly, highly recommend it.
Thank you for sharing all these great tips on avoiding founder burnout. I think another thing, just to add here, for solo entrepreneurs, what I find that can be helpful is it may seem elementary, but really putting a priority list of what are things that only you can do and that you can drive the company to the next level. And everything else, think about, is this something you can delegate to your existing team or outsource? And some things that you can outsource are putting your books together, getting your taxes filed, putting together a financial forecast. So just a quick plug that Pilot can totally help with this if this is of interest to you. But if not, if you're still at an early stage, definitely think about delegating those. The amount of time you put into putting together your books could be time that you're using to close sales, and you need to make that decision on what is my time going to be most important to spend towards. And from that process of elimination, you can start prioritizing. I'm not saying I'm an expert. I don't know the full perfect formula here, but I've seen this work for a variety of companies. All right, we have so many great questions. Let's start with this question from Miguel. A question for Caroline and Katie. How did your plan for selling your products, either via direct-to-consumer, e-commerce, or retail, affect your decision about which funding route to go with? And I'd like to start with Caroline on this question, because one topic that we'd like to cover here is another alternative funding path could also be loans, and that can impact a non-dilutive way for you to get that quick access to capital without giving up equity. So Caroline, if you could give a quick intro about what that is, how to qualify, and that bake into your decision based on your product and the channel that you are planning to sell into.
Sure. So I can take both of those things. So Eugene just mentioned the possibility of financing your business through loans. And so what Walker Brothers has been able to do is take advantage of equipment financing. So if you've ever been to a brewery, like a beer brewery, a kombucha brewery looks pretty similar. There's a lot of stainless steel in the production space. And fortunately that those tanks and things are easily underwritable. So you can get pretty advantageous equipment financing for that. And that enables any money that you've raised to go a little bit further, and you can retain some ownership. So we have taken advantage of that. Word of caution there is it does require a personal guarantee. So I think, unless you are a profitable business, any type of loan you're going to be taking is going to require a personal guarantee. So you just need to think about your personal financial situation and whether or not that's something you're comfortable with. But that has been something that we've used and do recommend if it's something that you feel comfortable doing. Around the question about kind of roadmap for sales channels like direct to consumer distribution, that didn't factor too much into our fundraising path. I think for us, the amount of money that we were raising last year, it was small enough to do quickly via angels. So we went that route. It didn't really have anything to do with our kind of path for getting our product into consumers' hands. That said, the pandemic did have some stuff to say about that. So we kind of followed a typical craft beer path working with distributors. And then when the pandemic hit, we did a little bit of direct to consumer, and that's kind of become a kind of a more robust channel for us, but still distribution is where our main focus is.
Yeah, distribution is a key topic here in the consumer space. Katie, can you talk about how did you manage the fulfillment process, which is also an important part pre-distribution in the early days? Did you consider outsourcing to a 3PL, for example? And I know we're going to more operational question, but it is relevant here because as you're going into seeking funding, these are questions that your investors will also ask.
Totally. Yeah, they will ask every question under the sun, which is great because if you haven't thought about it, it's a good forcing function to have a conversation. So most of our products are shipped frozen, which was the biggest constraint for us on fulfillment. When we were launching the company, we didn't fully realize just how critical fulfillment was. Fulfillment for us is not just a back-end portion of our supply chain. It's almost another one of the services we offer our customers. So we launched direct to consumer, in part fueled by the pandemic and in part because that's one of the fastest ways to bring your product to market as an e-com company. And initially we were launching just as a beta and we wanted complete control. And as a frozen food company in beta with tiny volumes, it was hard to find a fulfillment partner that would take us on. So we built it ourselves and we were self-fulfilling for almost an entire year. And then the pandemic hit and we started to grow really quickly and continued self-fulfilling because solving that problem was just one of many things on our to-do list. And starting that way gave us great insights because we knew every single thing that could go wrong in the box from our hands to the customers. And when picking the right fulfillment partner, we could really grill them and ask every question. I don't think we would have had the same data if we had just gone straight to a fulfillment center, but we definitely would have saved days and days and days of headaches trying to learn how to rebuild a wheel from scratch.
Thank you, Katie. Lisa Marie, I know you have some experience here as on the fulfillment side too. Maybe you can share a bit more about how fulfillment works at Gifting, any lessons learned that you can share with our audience today.
There's been a lot of trial and error. So keep in mind, we're not a single product. We're like a conglomerate of multiple diverse and inclusive products. So because we specialize in curated gift boxes, each gift has to be packed perfectly by hand with crinkle paper. We originally thought that we would be able to, partner with Shipmonk or another 3PL and have them pack everything. That was not the case. It was going to be extremely expensive to do that. It's not just a kitting service. We're not just throwing things in the boxes. We're actually perfectly packing it in with paper. So it's been crazy for us. For example, we are still working out of my old apartment in West Hollywood. So we had a 3-bedroom apartment that I lived in. We first took the tiny little office in the back, and then we grew out of that. We kicked my brother out, took the guest room, moved out of that, took over the living room. And mind you, each room after we moved out of it became like another storage room and another packing room. And finally, we took over the whole thing. I got kicked out of my own bedroom. That's our new office. And we still fulfill out of there. Thank God I just put in an offer on a warehouse yesterday, but it is critical. I think, Katie, like you said, for you to at least master it in the beginning so that all of what's possible or what exactly you want, because at some point we do hope to pass it off to someone else, because in May we did 3,000 boxes out of that little apartment and it was pretty miserable. So I'm hoping that we can get to the point to pass it off, but I think doing the trial and error yourself and knowing exactly what you want and exactly what you don't want is really critical to your business's success.
Thank you, Lisa Marie. I think that trial and error resonates across the board in any operational decisions that founders will make in their business, whether you're outsourcing fulfillment or anything else that's critical in launching or delivering their product to your customer. Caroline, we have a question here. Maybe as you kind of grow your business and you're raising angel money, have you seen any questions around what your cap table mix will look like as you grow? So another way to think about it is, when you're raising angel money, do they then look at loans as a way that, okay, you have raised this capital to grow your company, or are they much more focused on your story and your growth as a company? And I can share my thoughts from an institutional VC perspective later as well.
Yeah, so I'm not entirely sure I understand the question, but speaking about the cap table composition, I would say that you never want to have a messy cap table, but I think if you set a minimum check size that you feel comfortable with, the administrative headache is really just a K-1 filing, depending on how your business is set up. So to your point earlier, you need to take the phone calls and take the checks so you don't miss out. I would say that's my philosophy too. I think where this can get messy is if you have obviously, if you have some type of IP that was spun out of a university, then things can get really complicated there. But when it's pretty straightforward, my instinct is to take more conversations rather than fewer. And then on the loans piece, for us, that's not a significant portion of funding for our business at all, but it does help. And I've spent the last 5 years in the UK, so as Tesco says, every little helps. I think that's true in running a business as well.
Yeah, and chiming in here, I totally agree with that. I think as long as your business is showing strong momentum, if anything, it has shown that you can maintain that credit line, and that is so minimized in the grand scheme of things when you're raising VC money. So I wouldn't worry too much about that aspect. And similar question, I guess this is relevant to Lisa Marie and also to Caroline. As you started a company and have co-founders within the company, how did capital infusions from founders impact relationship between the co-founders, if any?
That's interesting. Are you saying like when we got outside funding, how did it affect our relationship internally?
Or I guess when you're first starting to determine the equity split between one co-founder to the other, did that affect like your relationship either prior to founding a company together or working towards building the company? Because from the sounds of it, all of you have great co-founder relationships, and we'd love to hear how you managed to make that happen. Because we've read cases of co-founder relationships going sour because they are sharing equity within the company.
Yeah, absolutely. I think that's a really, really good question. It's not always going to be rainbows and butterflies. You know, things happen, and I am extremely grateful that my co-founder and I are both extremely understanding and more than anything, just calm and sane people. I think, you know, I've heard really bad horror stories of people working just with horrible co-founders who, you know, will somehow boot them out of the company. They leave with no equity, and it's a really messy situation. I think finding somebody with a lot of similar morals and values to you is extremely important. And on top of that, when you guys are going in, everything needs to be in writing, and there needs to be very, very clear, definitive lines of who's expected to do what and who's putting in money. So for example, I started the company with my unemployment. I reached out to the person that I wanted to be my co-founder, and I was basically like, I want you in this. I really would love to be 50-50 with you. This is how much money I've put in. This is what I've done. And she came back and said, hey, I'm actually willing to give you X amount of dollars, but I only want 20% of equity because I don't want to be as involved as you are. And I want this to be your company. And I'm here to, you know, be on the journey, provide really strategic advice and be there with you, you know, as a ride or die co-founder. But I know that I'm going to have some sort of, you know, exit plan of sorts, maybe before you do. And I was like, okay, this is actually really great. You know, it worked out for both of us. And I think that it's been critical that things are in writing because, you know, as things change, every month is different. One month I might do 100% of the work because, you know, she is sick. Or for example, I had kidney stones last week and I was out of the office for a week, and it was a critical week for us. And she fully stepped in and was in the office every day when she's not required to be. So I think things clearly need to be defined, but also find somebody who cares enough to kind of jump in as needed.
Yeah, I echo everything Lisa Marie just said, especially the point around, you know, making sure that you and your founders have, you know, similar ways of viewing the world. I think that can be really helpful. Yeah.
Also, sorry, can I just say one more thing? And also not just similar ways of viewing the world, but similar visions for the company. Because when we started, I definitely felt like we were both on the same page. And then a month in, we were both like, whoa, hold on. We did not realize that you wanted this and I wanted this. And it could all just go back to how much time and energy you're willing to dedicate, but also having the same long-term plan for the business and not just yourself is critical.
That's exactly what I was going to say. And asking why do you want to build that kind of company, or why does it look that way in your ideal? And understanding the underlying motivations, because things change all the time, just like Lisa Marie said. So at least knowing that when things change, you can predict which way you will each go is really helpful.
Yeah, sharing the same principles are key to a great co-founder relationship. So thank you all for sharing your experience there. We have a couple minutes. I want to make sure that you can fully encapsulate your journey as a founder and some of the lessons learned. Say, for example, I'm a first-time founder. I've just bootstrapped my company. I'm raising capital for the first time. Let's go around the room. If you could give like a quick tidbit of a checklist or lessons learned that you can share with the group to take away and tactically apply that to the company, that would be amazing. Caroline, would you like it to kick us off?
Sure. I think my biggest piece of advice is start a newsletter for your existing investors. Maybe quarterly. That's what we do it. Keep them posted on sales progress, what's in the pipeline. I think it gives everyone an additional sense of like ownership of the company. They know what's going on, and then the intent is that if you want to raise again, they're keen to take their pro rata share. So that's my tidbit of advice.
I can dive in. I am a first-time founder, first time raising money, and I would definitely say, of course, I already forgot. I would definitely say ask all the questions. I was very scared and embarrassed to ask questions in the beginning because a potential investor or a current investor would say something and I would just be like, oh yeah, totally. And instead of actually trying to grasp the concept that they were trying to tell me, I just pretended like I knew it and it actually came back to hurt me. So no question is stupid. Ask all the questions, do all the research, and never be afraid to ask for help when you need it. Because at the end of the day, other founders have been in the same position you've been in. Investors want you to do good and they want to see the business grow. So they're always willing to help you.
Totally agree with that point. I was trying to decide which piece of advice mine would be. Either find that founder circle to surround yourself with, even if it's just a Slack channel that you check in on every couple of days. Ideally, you have people to vent to who have been through it, somebody who's 6 months ahead of you, somebody who's 2 years ahead of you. Find those people. The double edge to that sword is your company best. There are a million ways to build a company, and people will give you competing advice on everything if you ask for it. So ask for it, but then know yourself and know your company and have confidence.
Yeah, I thank you all for sharing that. I think, as I said before, being a founder is a very stressful role, and I have a lot of respect for folks who are founders. Ultimately, at the end of the day, you know your company best, have the confidence to go into a pitch meeting and kill it, prepare for it ahead of time. I think someone asked a question about timeline. In the past, what I've learned as like the best time to prepare leading into when you think you may need funds is make sure that you have at least 6 months of runway. So with that 6 months of runway, ideally you want to raise that money before you hit that 1 month of runway and work backwards from there. So this makes sure that you are confident going into the pitch meeting. You're not in a rush to get money so that you don't take a bad deal. And you also get that resource and that support system to help you prepare for it. So I love the idea of making sure that you are asking questions, having that founder circle, because more often than not, folks have gone through it before and can share with you even tidbits like, this investor is most likely to ask these questions. You should prepare for that. And that's very helpful going into any pitch meeting and any negotiation. All right.
Yeah, that's great advice.
Yeah, and to wrap it up, I also want to bring home the point that there are many different alternative ways to raising funding for your company. Today, we talked about raising venture capital, angels, family and friends and family round, pre-sale boxes, as well as different types of loans. And from our great audience on the chat, there's also things like crowdfunding and a lot of alternative methods. I've also seen like inventory factoring. There's no one right path. You know your company best, and you can choose the right path based on the trade-offs that you see on the table. And with that, I want to thank FounderMade for putting together this great panel together. I am so happy that I got to chat with all of you today, and I'll pass it over to Megan to wrap it up now.
Thank you guys so much. What an amazing conversation and so many great takeaways and pieces of advice for our audience. So quickly before we go, I just want to share where our audience can stay in touch with you guys. We'll share some links and handles and everything so you can follow along with their journeys. And then coming up next on the Founder Made event calendar, next week, we actually have a power hour with Air House that's called The Early Days, Launching and Growing Your D2C Brand, which I think is really complementary to this session. We're going to be talking through all sorts of, operations and ways to scale once you have that funding, and as you're building your brand, how to scale from there. And then on September 8th, we have a power hour with Ada Support talking about best customer service practices and engaging with your own community. And on September 23rd, we have our virtual summit, the Future of Beauty and Wellness Summit, where we'll be featuring tons of amazing beauty and wellness brands and talking through lots of amazing content. But thank you guys so much again for joining us today. Hope you have a wonderful rest of your week. And audience, please stay in touch with our amazing speakers that we've had today.
Great to meet you guys. Bye.
Bye, everyone.
Bye.
Bye.